Ownership in real estate is the foundation of property law. It determines who controls, uses, transfers, and inherits property, and under what legal structure. In earlier chapters, you learned that ownership is a freehold estate, meaning it carries possession and duration of ownership. In this chapter, you explore how that ownership can be structured by one person, multiple people, married couples, business entities, or even fiduciaries through trusts. Each ownership form carries unique legal implications for taxation, inheritance, liability, and decision-making authority. First, sole ownership, tenancy in severalty. When property is owned by a single person or legal entity, it is held in tenancy in severalty, the simplest form of ownership. The term severalty means that the owner's interest is severed from all others. This form gives one owner complete control over the property, with full rights to possess, use, lease, mortgage, sell, or transfer it without needing consent from others. Corporations and government bodies also hold property in severalty because they act as single legal entities. Example, if John Doe, a single man, buys a parcel of land, he owns it in severalty. He can later build a structure, sell the land, or leave it to his heirs through his will without requiring any co-owner's approval. Arizona distinction. In Arizona, if a married individual wishes to own property separately, the non-owning spouse must sign a disclaimer deed, releasing any community interest. For instance, John Doe, a married man, as his sole and separate property, means his spouse has no legal claim to the property unless the deed is changed later. Sole ownership ends when the owner dies, transferring through probate according to the owner's will or state succession laws. 2. Co-ownership, concurrent ownership. When two or more people hold title together, it's called co-ownership or concurrent ownership. Each co-owner shares the right to possess and use the entire property, though their ownership shares may differ. A. Tenancy in common. This is the default co-ownership form in Arizona unless otherwise stated. Each tenant in common holds an undivided interest, meaning no owner can claim a physical portion of the land. Everyone shares the whole. Shares may be equal or unequal, e.g. 60%/40%. Each co-owner can sell, mortgage, or will their share independently. No right of survivorship. If one owner dies, their share passes to their heirs, not the surviving co-owners. Example, if John, 60%, and Mary, 40%, own an investment home as tenants in common, John's share will go to his daughter upon death, not to Mary. If disagreements arise, co-owners may request a partition through the courts, which can divide the property physically, or order a sale with proceeds split according to ownership percentages. B. Joint tenancy with right of survivorship. Joint tenancy is a popular form of co-ownership among couples and family members. It includes the right of survivorship, which means when one owner dies, their interest automatically transfers to the surviving owner ease, bypassing probate. To establish joint tenancy, 4 legal unities must exist. Unity of time. All owners acquire their interests simultaneously. Unity of title. All owners acquire title through the same deed. Unity of interest. All owners hold equal ownership shares. Unity of possession. All owners have equal rights to use the entire property. Example. If 3 siblings own a cabin as joint tenants and one dies, the remaining 2 inherit the deceased's share equally. When one survivor remains, ownership converts to tenancy in severalty. Breaking any unity, such as by selling a share, severs the joint tenancy for that portion, converting it into a tenancy in common. C. Tenancy by the entirety. This ownership form exists only between married couples, including same-sex spouses in many states. It treats the couple as a single legal entity, giving each spouse equal, undivided ownership and the right of survivorship. Neither spouse can sell or encumber the property without the other's consent. Benefits. Offers survivorship like joint tenancy. provides creditor protection. A creditor of one spouse cannot force sale of the home unless both spouses are liable for the debt. Termination. By mutual agreement, divorce, which converts ownership to tenancy in common, or death, which leaves full ownership to the survivor. D. Community property, Arizona specific. Arizona is one of 9 community property states. All property acquired by either spouse during marriage, except for gifts or inheritance, is presumed to be community property. Each spouse owns a 50% undivided interest in community assets. Separate property includes property owned before marriage, inherited property, gifts received individually, or property kept separate from community funds. Examples: a home purchased during marriage, community property; an inherited cabin kept solely in one spouse's name, separate property. If one spouse dies without survivorship, half belongs to the surviving spouse, the other half passes by will or intestacy. With right of survivorship, surviving spouse automatically inherits the entire property. This ownership form ensures fairness and equal partnership within marriage, aligning with Arizona Revised Statute Section 33-431E, Tenancy in Partnership. Used for business or investment purposes, this form allows partners to hold title to property used by the partnership. Title is held in the name of the partnership, not the individual partners. Each partner has equal rights to use property for business operations. Property cannot be sold or encumbered by one partner alone. Upon dissolution, property is divided or sold according to the partnership agreement. This arrangement is governed by the Uniform Partnership Act and ensures that real estate remains tied to business purposes rather than personal ownership. 3. Ownership in trust. Trust ownership introduces a fiduciary relationship designed for asset protection and estate planning. Living trust, inter vivos trust, created during the trustor's lifetime. The trustor may also serve as trustee and beneficiary, maintaining control. Avoids probate, provides privacy, and enables ongoing asset management. Can be revocable, modifiable, or irrevocable, fixed. Testamentary trust. Created through a will and activated upon death. Directs how property is distributed or managed for beneficiaries like children or dependents. Land trust unique to real estate. Trustee holds title for the beneficiary who controls use and profits. Offers privacy. Beneficiary's name doesn't appear on public record. The beneficial interest is treated as personal property, simplifying transfer and avoiding probate. 4. Common interest and corporate ownership forms. Condominium. A hybrid ownership combining fee, simple ownership of an individual unit, and shared ownership as tenants in common of common areas, e.g. pool, roof, hallways. Owners pay HOA dues to maintain shared areas. Each unit is a separate parcel, taxable and mortgageable individually. Cooperative, co-op. The entire property is owned by a corporation. Buyers purchase shares of stock and receive a proprietary lease to occupy a unit. The interest is personal property, not real estate. The co-op board must approve new buyers. All shareholders share financial responsibility. Timeshare. A form of shared property use. Owners or lessees have rights to use a property for specific time intervals, often weekly. May be a leasehold, temporary, or freehold ownership arrangement. 5. Business entities as owners. Modern ownership extends beyond individuals to legal entities for liability protection and investment. Corporation, a legal person separate from its shareholders. Ownership is through stock. Shareholders are not personally liable for debts. Limited Liability Company, LLC, combines pass-through taxation with limited liability, common in real estate investment. REIT, Real Estate Investment Trust, company owning income-producing property, offering shares to investors. These structures help investors pool resources, reduce personal risk, and manage multiple properties efficiently. Review summary. Sole ownership, severalty. One person or entity holds full title. Tenancy in common. Co-owners hold undivided shares without survivorship. Joint tenancy. Equal shares plus right of survivorship. Requires 4 unities. Tenancy by the entirety. Married couples. Equal ownership plus creditor protection. Community property, Arizona. Equal marital ownership. Survivorship optional. Trusts. Property held by a trustee for beneficiaries. Avoids probate. Condominium. Fee. Simple ownership of unit plus shared interest in common areas. Cooperative. Ownership through shares in a corporation plus proprietary lease. Timeshare. Scheduled usage ownership or leasehold. Business ownership. Partnerships, corporations, and LLCs manage investment property and liability. Real estate professionals must identify these distinctions in every transaction to ensure clear title, accurate vesting, and lawful conveyance.